Well, we've been talking about the three pillars of a low, and I'll get into that a little bit. But really, the condition for that, or the precondition for that, is trend identification. If you're in a downtrend, those three conditions I mentioned aren't nearly as supportive of a low. You really need other factors to come into play. A little deeper oversold conditions, a little more from a sentiment perspective. There are a few other tricks up our sleeves that we use. But the good news here is that we're still in this bullish condition from our trend model, and as long as it stays there, and really it can go all the way back to neutral, and that's fine. It's when it crosses back below to neutral bearish that we start to worry about the underlying trend. So we're still in a good spot, and that says to us that the oversold conditions and these tactical lows should be bought. The other thing that I think is important, I'll just take you back to where we were back in December. This is some work that we did back in mid-September after we had this spike in 20-day highs, not 20-day lows, but 20-day highs. In December, specifically the 14th of December, 20-day highs reached 71.4% on the S&P. And when we look at that, when we plot that here, you can see this number here is at 71.4, this line right here. And if we look at 6-month forward returns, you can see that all of these actually end up being positive. Now, there's only 6 of them, but when you have such an extraordinary high number as 71% of 20-day highs, the 6-month forward return on average ends up being about 14%. We put a year-end target of 5,800 on the S&P because we know 12 months forward, this same number ends up being plus 22%. So we're still in the sweet spot of working off these 20-day highs and having that momentum, as we call it, escape velocity, to continue to press this market higher. So escape velocity isn't something that you get to it and then it just reverts. It actually tends to continue and has that persistence. Now, after you get 6 and maybe 12 months out, you start to have to rely on trends because you're not going to have that same type of momentum to get you there. So I still think that this market is one in which we're in a bull phase, and we've just had this correction in this bull phase. A lot of that being a function of the momentum that we talked about 6 weeks ago, which was, look, momentum is in this 90th percentile, and that's the point at which momentum, which we are momentum players, but momentum tends to be a liability. And so now we're seeing the ramifications of that, or the offshoot of that, and we're getting this oversold condition. So the first thing, the first pillar, is an external oversold condition. External means that we're just looking at the price of the market itself. We don't care if it's Nvidia, we don't care if it's Freeport, we don't care if it's GE. We just care about the actual indice itself, the price indice, and that got oversold in our oscillator to -3. And once you get to -3, that condition is oversold as long as we're in an uptrend. Now, we use our trend model, but you could use something as simple as the 50-day above the 200-day. You could use the slope of the 200-day moving average. A lot of different ways to think about that. We use our trend model. Either way, we're oversold in an uptrend. The other is that we look at internal oversold conditions. What do we mean by that? We mean that we're looking at the constituents. We look at the S&P 500. It means that in aggregate, we are looking at the 500 names and what's happening to those individual names and then summing those up. And in this case, we're looking at 20-day lows, just the opposite of those 20-day highs that we talked about. Usually when 20-day lows are spiking, again, in an uptrend, getting above that 50 percentile, we know that we're getting into a point of what we call indiscriminate selling. That means risk managers are forcing people to take risk down. That means that people aren't choosing between Freeport, Nvidia, and GE. They're just selling everything. And so when that happens, it usually is closer to the end. Now, you can get divergences, and in fact, this one right here, you can see that we got this low, and then we get the divergence. That can happen, so we have to be a little careful and a little on guard on that. But certainly, more times than not, as you can see from these stats up here, 3 months forward, 12 out of 15 times, you end up with positive returns. 6 months forward, 11 out of 15 times, you end up with positive returns. All of these with pretty good skew, upside versus downside as well. So it's something that we do pay attention to, and it's an important part of those preconditions. And you can see when we take this back further, this is back to 2015, but 20-day lows in this 98th percentile because we got to 53%. I think what's interesting is when we look at, say, 21-day versus 63-day, the 3-month returns are actually better. They're more predictable. They're stronger than the 1 month, and that just gets back to that divergence, right? You can end up with, you get the spike, you actually move lower, fewer names are driving the index lower, but it still ends up being part of the basing or the corrective process. So certainly something that we have to keep in mind, that it is possible that happens. You can see took place back here, took place back here. Obviously, this one was more of a failure. You had several which were premature during COVID. Even in the bear market, you had pretty nice little rallies off of this, but they did end up rolling back over. And we have other ways to measure that, but we'll cross that bridge when we get there. But for now, the internal oversold condition looks pretty good. And then the other part that we look at again is the percentage of issues, again on an individual basis, that have their 21-day stochastic below 20. And so when that happens, 75% of the time we get oversold. Again, same story. The 1-month return is not as reliable. 64% of the time you're higher. 82% of the time you're higher on a 63-day basis or a 1/4 forward return. Again, with pretty bullish skew, the average return there is 8.8%. So again, that's in line with that 20-day high that we talked about from December. All those look pretty good, and we think we're actually set up pretty decently for the summer. The big question remains is sentiment. Sentiment barely budged. We did get 1 day of put call activity that started to spike, but 1 day really isn't enough. We like to see persistence there. The 5-day moving average, the 10-day moving average, the 25-day moving average, neither one of those is in a elevated state. So it doesn't have to happen, but certainly we feel most comfortable and pound the table a little bit more forcefully when we have sentiment in our favor.